Welcome to our world. To show you the complex and rapidly moving world of commodity trading, we'll use oil as an example. Commodity traders need to have a wide overview of the global economy and of how all the individual pieces tie together. Everything you see here helps to influence the supply and movement of oil and the price paid for it. Oil doesn't travel straight from the refinery to our cars. Storing oil in tanks is an important part of the flow of the oil trade, and correctly identifying tankage capacity across the world is part of a commodity trader's job. Traders also need to follow political developments across the globe, which may affect the supply or demand for oil. If immediate delivery is required, this is handled by the spot market. It's a small but significant fraction of the global oil market. Individual trades are usually expressed as a premium or a discount to a benchmark price, so traders need to keep a close eye on these benchmark prices. It helps if commodity traders can predict the weather too. Demand varies seasonally. Natural and man-made disasters can disrupt shipping routes. For a competitive advantage, as well as keen pricing, the availability of efficient logistics within the supply chain is important. Generally, commodity traders aren't worried if the price of oil is high or low. The skill is to identify price differentials between locations or in the grades of oil. So, traders need to have a solid understanding of the chemical constituents of oil and how and where blending different grades can be done. A trade will need financing to bridge the time lag between buying and selling commodities. The cost of this finance will vary, so the trader factors this in to each trade. Commodity traders need to think about how the market will move in the months ahead. The futures market sets what the price of oil is expected to be. Futures trading at a premium or a discount to the spot price gives a valuable indication as to whether inventories are rising or falling. Risk management plays a key role in the life of all commodity traders, who work closely with their team to manage exposure to risks caused by market volatility. They will also try to limit their credit risk by partnering with financial institutions. Commodity traders also need to factor in the availability of ships and cost of transportation into each trade. They need to understand existing trade flows and changing price differentials, as well as taking logistical factors into account. Finally, the availability and pricing of substitute products such as different grades of oil, or even an indirect substitute such as renewable energy, can affect supply and demand for oil. So, the commodity trader has much to take into account, and the next time you are filling up your car, spare a thought for the many commodity traders who have made that everyday activity a reality.